Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's very important webinar on three standards. That is standard on SA 600, revised standard SA 610, and SA 620. These three standards deal in using the work of another auditor, using the work of internal auditors, as well as using the work of an auditor's expert. And in order to tackle this very important uh, these three standards, we are having with us our very important, very learned speaker from our own Chartered Accountant fraternity, CA Ashish Gupta ji. So, on behalf of Institute of Chartered Accountant of India, as well as Auditing and Assurance Standard Board, I welcome you, Ashish ji, on this webinar organized by AASP of ICI. I also welcome all the participants of today's webinar who have joined for this very important webinar organized by AASP of ICI. So before we formally start this webinar and request our learned speaker to start his deliberation, it is my proud privilege to share with you the brief profile of our today's speaker, C. Ashish Gupta ji. Though the profile is very large and Ashish Gupta ji always says, speak only 2-3 lines about me. So I will cut short the profile. Ashish ji is graduated from Shri Ram College of Commerce, Delhi University, and intended in audit at a large audit firm in Delhi at Wakal Chandiok and Company LLP. He has gained experience of auditing some of the fine and largest companies in India across sectors. Ashish ji has also done exclusive learning from Harvard Business School on professional services firms. So, without wasting much more time, this was the very crux and brief profile of Ashish ji. So, I request Ashish ji to please start his deliberation.
Right. Thank you, Anil ji, and I hope you'll cover well. Thank you. Am I audible, Nimal? Okay, great. Good afternoon, everyone. It's a Monday afternoon, and I'm sure there are a lot of things that are lined up for you. So what I'll try and do is I'll try and make this really sort of a practical oriented. Of course, there will be a lot of theory around these three standards. These three standards are as Anilji also mentioned, quite complex because what we often miss out is the intricacies of dealing with these standards. And my attempt would be through this afternoon is to help you understand the standards, of course, but also overcome some of those intricacies which I've experienced in my professional career thus far in dealing with these standards, just helping you learn some of those practical aspects as well. My request would be, please do write a lot of questions. I'm sure there will be a lot of questions around these standards, and I'll be very happy to take them after the end of the session. As Anil said, there are three standards that we're going to deal with in this afternoon. One is the SA 600, which is using the work of a competent auditor, where you essentially you're the principal auditor, you're auditing and opining on the consolidated finance statements, or even as the auditor of the financial statements, whereas one component is audited by somebody else. So how do you deal with that situation? That's SA 600. 610 is where you use the work of the internal auditors, and SA 620 is where you employ auditors expert auditing some of the important financial statement, either line items or assertions or certain components of your auditing aspects. So these three standards, as I said, because of the nature of the complexity, I'm going to be dwelling a lot on SA 600 because that's where the standard is very commonly applied. I'm sure as professional accountants and auditors, we deal with situations where we are the auditors of the company that has various components, or we deal with a situation where it's a multi-location company where there are multiple branches or divisions, where some of the branches or divisions are audited and handled and undertaken by a separate auditor, either for local familiarity and so on and so forth. So this is a very commonly applied sort of standard, SA 600. And it is very different from what you see in the international standards. The ISA 600 equivalent of the SA 600 is fundamentally different. So I'm going to therefore apply a little more time to SA 600 to help you understand that better. Let me start sharing my screen so that we can start the deliberations. Hemel, just let me know if the screen is visible for me to start. Okay. Okay. Right. So, but of course, I'm going to also delve on both the aspects of internal audit and the auditor experience. Again, from a perspective of what, as professional accountants, what we need to do and what we shouldn't do in respect of applying these standards, of course, talking about a little bit of theory. Coming with SA 600, as I said, my objective would be to achieve three things. One is help you understand the standard, the Indian standard, which is SA 600. Then I'll also walk you through what good documentation look like, because there's a huge uh, deficiency that, for example, I've experienced when I, for example, review the work papers of some of the others, in the profession, that there is a huge gap in terms of how do you really go about documenting your work around SA 600. And third is that I'm going to then talk about some of the key practical challenges, and again, from my experience, how do you address some of those challenges? And trust me, you'll be surprised to know that some of the audit reports that you currently may be issuing around them could contain some of those challenges, and therefore it'll be important for you to just focus on them as well. So starting with a little bit of theory, as you all know, standard by itself talks about the fact that you are using the work of another auditor. Now, here are the three important definitions that you have to keep in mind. First of all, principal auditor. Second is other auditor, or can be used as a component auditor. And third is a component. Now, these three definitions are very important for you to understand what is a principal auditor. So let's say you're a company A, you're an auditor of a company A that has a subsidiary called company B. Now, you being an auditor of company A may not necessarily be that you'll also be the statutory auditor of a company B, right? Now, company B is, say, audited by somebody else. Because company B is a subsidiary of company A, the company A, under the Companies Act 2013, will have to issue both standalone financial statements and consolidated financial statements. So you, as a parent auditor or as the auditor of company A, you'll be giving an opinion on both the standalone financial statements of company A and the consolidated financial statements of company B, which will include the component of the subsidiary called company B. Now, here you are the principal auditor. So principal auditor is the auditor who has the responsibility for reporting on the financial statements of the parent company, right? And the other auditor, or let's say, whose responsibility to issue an opinion on either the financial statements or the consolidated financial statements, the main, audit report. The component auditor is basically auditor of that component in which which is basically consolidated into the main company. Now, component, as I just explained to you, component could be either a subsidiary, could either be a joint venture, could be an associate, could be a branch, could be a division. So anything which basically essentially amalgamates and consolidates into the main financial statements. And don't take my word amalgamation as the amalgamation generally understood, but in preparation of the financial statements of the company, when it has multiple divisions, each of those divisions will aggregate into that company. So each of those divisions are separate components. If it's a group financial statements, then each of the components would be subsidiary, joint venture, associates, which will eventually be consolidated in some form and shape into the parent company. So each of those, subsets, you can say, will be called as components. So that's a little bit of theory. As I said, just to sort of illustrate, so let's say this is the company X, you can see on a screen, where you are the sort of auditor, and then there is these different components. All of these are essentially called the different components, and those components essentially will all add up to company X. So if you're an auditor of company X, you are the principal auditor, right? You could be referred as group auditor. I mean, that's a very common term used as group auditor, principal auditor, parent auditor. These are all interchangeably commonly used terms, right? And if you are an auditor of A, B, N, D, right, you could be playing the role of either a component auditor or also a parent or a principal auditor, depending upon if you are multiple. Let's say if you're an auditor of N, right? In this example, in this situation, N, you're acting actually both as, and suppose N is a listed is a company in India, and which does not, where you don't have the exemption of excluding consolidation, and where the company N also prepares consolidated financial statements. In that case, you're acting first as a principal auditor of N, where the components of Z, G, and Y essentially consolidate, but you're also acting as a component auditor to X, right? Now, X and N auditors could be different. So you have to understand the group structure, understand what's your role as a principal auditor or a component auditor. This standard essentially deals with a situation where you are the principal auditor and you have the ultimate responsibility of issuing opinion on the financial statements of either X or N in this case, for example, right? As I said, the key characteristics of any group audit is, first of all, you have to understand that the standard says that while the principal auditor can have a concept of a division, and we talk about that division responsibility, the overall responsibility of the group audit lies with the principal auditor. And that's a very, very important statement to make. Now, somebody could come back and say, by the way, we do see paragraphs where we say a component which is not audited by the principal auditor, is scoped out into another auditor. So how can I, as a principal auditor, be responsible for the work done by the component auditor? Now, here you have to understand the nuances. While absolutely the standard does give a bifurcation to say, okay, as a principal auditor, I can say that this component is audited by somebody else, and therefore the work of that component is done by somebody else. But I also add a line in the paragraph to say the work of who have been relied upon us for the purposes of our opinion, right? Now, what this means is that it is my responsibility as a principal auditor to make sure that I design my procedures under SA 600 in a manner that I can say that I have done enough work, I have obtained sufficient and appropriate evidences, stroke procedures to be able to say that yes, the group audit is, my opinion, is free from any material misstatement. And we'll dwell upon this a little bit. But please hold on to that thought that while there is a concept of a division responsibility, but that doesn't mean that your responsibility is completely absolved as far as the component is concerned, which is audited by somebody else. So just hold on to that thought for once. The second is that you have to be very clear in terms of determining what's your own participation in a group audit situation. And in my experience, I've come across situations where, for example, the total revenue of a company is, say, $1 million, right? And let me use Indian rupee terms. Let's say the total is about 10 crores of the company, and 7 crores of that, for example, sits in a subsidiary which you are not the auditor. The question that comes in is that if you're issuing an opinion on the 10 crores, you're directly auditing only 3 crore rupees, because that's where the you're directly obtaining audit evidence under SA 500 and so on and so forth. But the 70% of that, of the console numbers, is coming from the component which you're not directly auditing. So is it appropriate for you to be calling yourself as a principal auditor and taking the overall responsibility of the opinion? And that's a big question. And I can tell you that every firm has devised and designed their own benchmarks and thresholds to say, if, let's say, I'm not auditing as a principal auditor, as a parent auditor, I'm not auditing X percentage of revenue, assets, and profit of the consolidated numbers, then I'm not going to act as a principal auditor of that group. Now, that X percentage could vary, but in general, that is between 50% to 80% amongst all, let's say, large firms, that the benchmark they've set for themselves. But true, if you are a firm, if you're part of a wider firm, you have to determine what is it that you would want to be comfortable with in terms of participation. You have to understand that how much of the group, and we'll talk about again, as said, in detail about this, because very commonly these kind of issues come up, and we often are faced with this situation where the companies and clients will come back and say that, okay, why not just, even if you're auditing less than whatever X percentage, please go ahead and issue the opinion. We have to then take a stand and understand, okay, uh, do I audit enough to be able to issue an opinion on the financials? And I'll, again, I said, give you examples around that. The third aspect is, what is the extent of work that you will have to perform on the component's financial information? So one way is come back and say, and again, a very practical issue. Companies will come back and say that, okay, here is a component, uh, you know, is audited by another firm or another chartered accountant, for example. You will be given an opinion. Why do you have to do anything about that, right? So so again, while the standard uh, does talk about the fact that there is a division of responsibility, but at the end of the day, remember, the overall responsibility is yours as principal auditor or parent auditor or group auditor. So therefore, you have to determine to what extent you will have to perform, even if it's the components audited by somebody else. I'll give you a practical situation around this. So let's say you're auditing a company which has subsidiary in say Dubai, right? Now, there are a lot of trading transactions that are happening through that, and you find that the risk of material misstatement on either revenue overstatement or measurement, or both in terms of completeness and measurement, could be an issue. Therefore, you can very well say that while the component auditor of that entity could be another firm, they would have done their work. But I would like, as a principal auditor, to be able to look at the books and records of that company, look at how they're conducting their operations, etc., etc., and obtain overall comfort on the fact that the work done by the component auditor is reasonable. B, that there is no risk of material misstatement, especially around the assertions that I've identified. The, the standard does not restrict you. In fact, it obligates you to make sure that you make that judgment right upfront at the planning stage of the audit. And that's a very important judgment that you have to make, to say that, do I just rely on the work that is done, the opinion that is received from the component auditor, or do I do something more to be able to obtain some level of assurance and comfort that the person has done enough work that he or she is supposed to do, right? That's the third aspect. The fourth aspect around this is that often uh, the whole premise of the standard sits on communication and coordination, because here is a principal auditor, here is a component auditor of that component. Unless there is effective liaison, communication, and coordination between the two, you will have a situation of a flawed audit at the group level. And again, remember the first sentence, you have the overall responsibility as a principal auditor of the group audit opinion, right? So if you are found, if there is issue with respect to communication, which then leads to a fact that either a material finding was not effectively understood, reported, whatever happens, eventually, yes, then you can pass on the blame. You can say, the component auditor did not inform me. But imagine that if an investor is sitting on the parent, he sees you as the auditor and will come back and say that, hang on, please explain what have you done to make sure that there was effective communication, coordination between yourself and the component auditor. So these four aspects are very important characteristics of any group audit, and all of the standard necessarily revolves around these four characteristics. Uh, I'll just reiterate some of the common issues again. Maybe it's very important for you to understand, and we'll cover some of these aspects in detail through our deliberation this afternoon. One is, how do you deal with a situation when there are multiple jurisdiction components, right? And there are situations where your audit client has subsidiaries in different locations, where there could be an audit requirement under the local law. There could be exemption of audit of local law under local laws. There are different, let's say, language issues. There are different gaps when I say gaps, as in the generally accepted accounting principles in that country. Somebody could be following a very different, accounting practice. Tax laws are different. Underlying laws, jurisdictions are different. So how do you really deal with multi-jurisdiction components in group audits? That's a big risk. Second is you would often find, and I think again from my experiences, often there is let's say a limited or insufficient information knowledge about the group as a whole. So while you're designing your audit procedures and you're determining to what extent the component needs to be involved or whatever, unless you've understood the group and the operations as a whole, it will be very difficult for you to make that conclusion. It applies even to the other person, which is the component. The component often does not necessarily understand what is really happening with respect to the parent company or a different component. So let's say there is a common issue which is identified in component A, right? A component B does not necessarily know that the component A has this issue, right? Unless you sitting on the top as a holdco is able to then make sure that both of these components then talk to each other, and then we are able to understand if the same accounting issue applies to the component B or not. All of these components generally are isolated components, right? In terms of the auditor mindset, they don't necessarily talk to each other as, oh, I'm a fellow component auditor, let's talk. They all interact through you, which is the principal auditor. So therefore, there is often an issue with respect to the information that individual components have. And because of that lack of information understanding, there could be a risk of misstatement arising in that component. So again, how do you address that? We'll talk about that. Challenges in obtaining sufficient appropriate evidence. We talk about restricted access to component. Now this is very interesting. We've seen situations where there are large component, let's say they're big groups, and those groups have multiple legal entities that are large enough. And those legal entities also have audit committees, stroke board members, which are very active. They're not just representative of the parent company, but they also have independent directors. Now, you as a principal auditor often do not have access to those charged with governance of that particular entity. How do you ensure as a principal auditor that you are able to interact with those charged with governance of that and the management of those significant component is a big sort of question mark. And often, the natural response is that I don't need to deal with it because that's something that the component auditor will deal with it. But I would, again say that that's, to be honest, a myth than requirement of or an exemption available in the standard. So we'll sort of deal with that again, a challenge, because that helps, all that, because of the restricted access, you often end up not having sufficient information to be able to do a right risk assessment, to be able to understand the relevance of that component beyond just the quantitative numbers. So therefore, that becomes a bit of an issue. And again, last but not the least is the subsequent events. And classic situation is that your components, you're auditing a company that has 100 subsidiaries, right, across the globe. You're finishing your opinion, let's say on 1st of May, right? You will plan, the company by itself will plan to issue or get the component auditors to issue their opinions anywhere between 15th April to 25th of April, right? To make sure that the consolidation happens, everything issue sorts out, and you are able to sign off on the 1st of May. The question is, what if there is something that happens in the component between 25th of April and 1st of May? Your component auditor has already issued you an opinion which is, let's say, clean, nothing, right, in that opinion. All the financial statements underlying have all the disclosures, whatever you require those disclosures to be from the Schedule 3 perspective. But what if there is something that happens between 25th of April and 1st of May? You would not know, right? So how do you identify subsequent events which are relevant for your opinion? There is always a timing gap between your opinion and that of the competent auditor. And that timing gap often leads to risks of material misstatements. Either a disclosure is wrong or something happens which is an adjusting post-balance sheet event you would not know, and you'll have your opinion going haywire on that, right? So these are, and I'll give you how to solve each of those sort of challenges through our deliberations this afternoon. I think the first and the foremost question, and goes back to the second aspect from that principle of you are eventually owning up the group audit uh, opinion, is to answer a simple question: do I audit enough in the group to be the principal auditor? What is the extent of work I should do or in the financial statements, consolidated financial statements, to say that yes, I have obtained sufficient and appropriate audit evidence to support my opinion, right? That's the first and fundamental question around this. As I said, there are both the aspects of quantitative and qualitative. Quantitative, every firm has put their own thresholds. Those thresholds say that, and those thresholds generally are measured on three aspects: revenue, assets, and profit before tax. Again, these are based on experiences. All of these, and the underlying assumption of to what extent, we would be comfortable if, as a firm, that the component would be audited by somebody else. So that understanding of risk of material misstatement, I think, leads you to make that judgment of which proportion or what proportion of assets and liability, assets, revenue, and profit before tax, profit or loss, as the case may be, that you would want to do yourself, and what you would want the component auditor to do. That's a quantitative aspect, but there is also a qualitative aspect. The qualitative aspect could be a new acquisition. Qualitative aspect could be there have been a lot of errors in that component in the past. Qualitative aspects could be there was a fraud notice last year. Qualitative could be a completely different line of business, or there is a change in management. So once you evaluate both quantitative and qualitative aspects, then you can make a judgment of how significant that component is, right? So let's say, in the example that it's there on the slide, A Limited is a parent, and all of these B, C, D, E are subsidiaries. So if you see the turnover, 63% of the total turnover comes from A Limited, right? Which is fine, which is where you are auditors. Let's say you are the parent auditors, you are auditors. B is 6.2, 9.5, E is hardly, C is 21%, right? So you have to then determine, first of all, is the scoping of it. You have to determine which one of them are relevant components that you would want to focus your attention on, right? So if these are the numbers of 63%, 88%, 72%, I would say safely you can say that you can act as a parent auditor, right? Where B, C, D, E can continue to be audited by, let's say, different component auditors, right? And you can exercise supervision, as I will explain later on, how you will exercise supervision in terms of, and making sure that you say that you're able to demonstrate that you've done enough as a group auditor. But principally, structure one is that you can act as a principal auditor, and B, C, D, E can be audited by somebody else. But within that, the second question comes in is how would you focus on your attention and energies? Because right now there are only five. You can say that. Imagine there are 100 of companies, right, within the group. So how would you focus your attention? There again, as I said, you can apply a materiality and both quantitative, which is materiality driven, and qualitative aspects to scope it in. So in our example, C Limited, because it's a material sort of assets and revenue and profit contributor, this becomes an individually financially significant component. What this does is that your attention between B and C will change, right? If you see B, it's not that significant. E, to koi business hi nahi hai, right? So you can't be giving the same attention as a parent auditor to B, C, D, and E equally, right? So what you'll do, you'll have to therefore determine where is the likelihood of material misstatement. From the numbers, let's say, assuming all qualitative aspects are same, from the number perspective, C Limited seems to be the one where there is large numbers involved on revenue, assets, and profit before tax, right? Large numbers involved. So therefore, from a risk of material misstatement, C could be that component where, if not supervised well, there could be an issue. So what you'll do is your attention as a principal auditor, besides, of course, focusing on A, which is your own audit client, you'll start focusing on C as well. So first you determine whether you can act as a principal auditor, that you've determined through, determining the percentages, on revenue assets. And then second is how you have to devise your attention in the different components. There again, you'll apply these quantitative and qualitative aspects around this. Just again, illustration of how, you need to sort of focus your attention on individually significant component and individually not so significant component cannot have the same attention net, right? Now, just a snapshot of what work can be performed by different what the component does and what you do. Essentially, again, I'm not going to go into too much of theory because I'm going to focus a lot of attention around the practical aspect of it, and I'll show you the work papers, how they look like, what is the sequence of those work papers for you to sort of determine. But essentially, the component auditor is auditing that component, right? And therefore, their role is as an auditor of that component to report. Now, if it's an Indian component, it's an Indian entity, subsidiary, joint venture, associate, whatever, then the requirements of the Company is that the person, if CARO is applicable, CARO, if ICOFA is applicable, ICOFA, the auditor will have to essentially do all of those procedures and provide you a fully qualified, a fully comprehensive opinion. There are times where the financial statement adoption of the subsidiary may not be predating your financial statements of the parent from a statutory perspective. Under law, there is no requirement that the subsidiary financial statements or a JV or an associate financial statements need to be adopted by the board of that component subsidiary or JV for Companies Act purposes or statutory purposes before the financial statements of the parent company. There is no requirement of the law. So there are situations where the component auditor could not have finished their role as the auditors of that component, statutory auditors of that component, ahead of you opining on the consolidated finance statements, which means what? That you could have a situation where a component auditor essentially works under your instructions only till the time that you are giving the opinion, and that creates a lot of confusion and a lot of gaps in documentation. And again, I'll pick that up, gap of documentation and how you address those gap of documentation later on. That's where I was coming up to in the initial challenges that we could have these situations of different timing and all of that, right? As a parent auditor, as I said, you are essentially doing everything. You're owning up the group audit opinion. You are also going to be auditing or giving the ICOFA, which will not just include the component in terms of the controls, which the component auditor, of course, will opine on. But you're also going to be auditing the FSCP, which is the financial statements close process, which is part of the consolidation activity. Again, very common issue we've noticed in the past, where the principal auditor often says that I just need to aggregate all the opinions and just report the division of responsibility. I don't need to necessarily look at some of the elements of consolidation. That's not right. You have to look at the elements of consolidation. That's your responsibility, it's not of the component. Yeah. Moving on, I think the next aspect around is, first of all, as principal auditors, what are the basic things that you have to do? While the auditor of that component is often appointed by the management of the company, of that component, or maybe the parent company management, but it is your responsibility to assess the professional competence, independence, conflict of interest of that component, right? Management will not sort of do that. You can't pass it on to say that, okay, if the management has identified that Mr. X as an auditor, that Mr. X auditor, whether he or she is qualified to be that auditor or not of that entity, and I can use that work, is management responsibility. While management, of course, has to fulfill their own responsibility, your responsibility is also to ensure that you understand whether that Mr. X has the right competence, has the right skill set, has the right experience, is not, sort of impaired of independence, doesn't have any potential conflict of interest. I'll give you a classic situation, that would come up in one of your situation, one of your clients. Let's say, we have Companies Act, we have, Section 144A, which very clearly lists out what are the non-audit services that an auditor cannot perform. In some of the jurisdictions, while there are ISBA codes, all of that, but in some of the jurisdictions, such code of ethics are liberally used or applied. We've seen scenarios where maybe it could be a smaller country, where they're liberal, let's say, way of addressing, these situations. You could have a situation where the auditor is also maintaining books of records of that client and also opining on the financial statements. Now, the question comes in is, can you as a principal auditor take that opinion and say that I have relied on the opinion of that principal auditor or of that competent auditor? Well, the answer is quite frankly no, because you as an auditor know very well that that person is not independent to give an opinion to you under the auditing framework that you are auditing in. So you have to look at your auditing framework, not his auditing framework. Your auditing framework, that whether that component auditor is independent with respect to your auditing framework, right? And it's again a very classic. You would have seen in US listing situation where the auditors issue a PCOB opinion, right? The independence requirements of PCOB are far more stringent in terms of an generally understood requirements of ISBA and let's say even ICI code of ethics, right? You would have often seen that, oh, while I'm independent with respect to, let's say, an ISBA or ICI code of ethics, I'm not independent with respect to, the PCOB. In that case, I cannot act as a auditor for that component for the PCOB purposes, right? The management then will have to appoint somebody else who can issue an opinion which can be relied upon or sort of be, used by the auditor, parent company auditor, right? So you have to therefore understand and evaluate the professional competence, independence, objectivity of that auditor. You cannot pass it on to the management. Very common mistake that people often do, but that's your role as principal auditor. The second aspect of that really is you have to, as I said, determine where all situations where you have to visit your component. Again, I've seen situations where, and I would encourage that if there are individually material significant components, you as a principal auditor should make an attempt to do some supplementary procedures beyond just relying on the opinion of the competent auditor. What this does is it helps you corroborate your understanding of that component. It helps you understand the findings of that competent auditor whenever they come. It helps you understand, the opinion, for example, that the competent auditor has given, and appreciate that a little more. It helps you document that, okay, how you as a principal auditor have obtained sufficient and appropriate audit evidence with respect to the overall group audit, right? In terms of identifying those risks, because from a 315 perspective, you have the principal responsibility, right? As we discussed earlier at the beginning. So my suggestion there would be, whenever there are quantitative thresholds are met, let's say in the example that we had earlier taken, the C component, you had more than 25% of the profitability coming from that, of the group profitability coming from that component, right? Which means that component is very material. If the component is very material, I would suggest that you should make an attempt to do some supplementary procedures beyond just interacting with the component auditor, right? And I'll cover some of these other aspects in the documentation sort of aspect, right? In terms of the other aspect which often you would find in this standard is around how do you deal with a scenario of work paper review. Institute, as you know, the work papers are the responsibility and are the ownership of those work papers lie with the audit firm. Under the institute regulations, unless it's permitted by law or regulation or a court order, we can very well say that we're not going to get these work papers reviewed by somebody else, right? But in other jurisdiction, like in Europe, like in US, in Japan, and some other countries, it's a normal practice for you to review the working papers of the competent auditor. I would say again, if the component is material, either quantitatively or qualitatively, you should consider doing some bit of working paper review of those components where it is permitted under the standards to do that. I think what I will do is in just a bit of theory, because I want to use the examples of the practical examples to be able to then walk you through what documentation you'll have to do. The bigger question, so you've understood that what is a principal auditor, what is a component auditor, what is a component. I, as a principal auditor, what I need to do, what component auditor needs to do, how do I scope it in scope in a component, what are the consideration I should give, and so on and so forth, right? But then the question comes in is what is my reporting responsibility? And again, I'm sure most of you are aware, my reporting responsibility is that while I'm able to rely on under the standard, I'm allowed to rely on the work done by the other component. But I am the overall responsible auditor for the group audit opinion. So I need to make a judgment as an auditor. Can I rely on the work of that component? How do I deal with the finding of that component auditor? How do I deal with a situation where, for example, a component auditor is not able to complete his or her work? How do I deal with a situation where I, as a principal auditor, was not given sufficient access to the competent auditor? That is my responsibility. I can't shove it off to say, oh, I'm only going to just take on the opinion as it is, replicate it, and move on, right? I can't do that. I have to apply some judgment. And I'll give you an example. Let's say this in the earlier case itself, A, B, C, D, E, right? We've seen A is the parent, of course, C is the material component, and E had no business. Let's say there is a non-compliance of some laws and regulations in that E limited, and the auditor of that E limited actually qualifies and modifies the audit report of E limited, right? Qualifies the audit report of E limited to say that there is a non-compliance. Looking at the size of that entity, he believed that that non-compliance is material enough to be called out in the audit report, right? Now, because that auditor believes that the potential liability that could come up and his evaluation under SA 250 and 450 and so on and so forth, he or she believes that the liability could be material for that entity, right? Now, as a parent auditor, would you just take on that material, that qualification, put it into your main audit report and move on and inform the wider shareholders that here's the qualification? The answer is no. You have to apply your judgment as to that finding, as to that qualification. You can't just simply rely on and say that because that component is reported blindfoldedly, I'll just do that. I'll just replicate it. No. If that qualification is not material and relevant for the parent company, right? Then why would I carry that qualification? Let's take another example. The parent, the subsidiary auditor qualifies the intercompany transactions. The subsidiary auditor says that he did not have obtained sufficient evidence with respect to, let's say, an intercompany loan for whatever reasons, right? Now we all know at the consolidation level, the intercompany loan matches off, right? Then all that qualification possibly will have a tax implication that could come up, which could not be material at the parent company level. So would you still carry that qualification? The answer is no, right? So therefore, you'll have to exercise some judgment. You can't just blindly take on that work. Whenever you add a divisional responsibility, please understand that your divisional responsibility is added through a other matter paragraph, which is not a modification to the audit report, right? So while you are doing a division responsibility, you'll say, okay, this much component is audited by somebody else. I've relied on that work to the extent of the work done by related to that component is audited by somebody else, blah blah blah, and I've done my diligence on that. That's what I'm saying, right? But as I said, where we commonly mistake is while we just add that division of responsibility, we often do not understand that we also have to exercise our judgment on that component. And I'm just giving you two examples around it. What I'll do now is, again, in the interest of time, it's about 45 minutes into the session, and because I want to recap some of these aspects, I want to show you, how what good documentation really looks like, and this is again just a suggested documentation. These are not standard templates that the institute has issued, or or any other, let's say, regulatory authority has issued. This is just our experience of sort of dealing with uh, uh, you know uh, the components. The first and the foremost important document that you have to and you should evidence is the scoping document. The one I showed you earlier. How you arrive at this? How do you arrive at this A, B, C, D? How do you determine which is a material component, which is not a material component? That scoping documentation is your first document that you will put out with respect to the component evaluation. And this is very much within the 315 paradigm. So the 315 says that you have to do a risk assessment, right? So your risk assessment at the group level cannot be done without this scoping document. So first thing that you should document is how material is your component. Am I doing sufficient as a principal auditor? What are the material components? What are immaterial components? What are the other qualitative factors which are there that I need to consider for me to devise a strategy, auditing strategy, of which component I need to focus on particularly, right? That's your first document. The second document would be, and I would strongly, strongly recommend, if you're not doing that already, is to prepare detailed audit stroke review instructions. This is, in my view, the most important document, because if you read through the standard, which is, again, very broadly, it says that the auditor has to obtain, the principal auditor has to obtain sufficient and appropriate audit evidence with respect to that component, or let's say, or the work done on that component. How would you do that? How would you ensure that there is effective communication, coordination, guidance given to the component? While you rely on the work, tomorrow something happens, the component can come back and say, sorry, I didn't know this was material enough, or this was what you intended. Remember, I gave you an example of your auditing component X, which is the parent company, and there are two subsidiaries. The parent X, there are two components, component A and component B. Component A auditor does not interact with component B auditor. Let's say there is the statement that is identified in component A. For the same transactions, there are similar transactions in component B, right? Because the component B has missed out. Now, you as a principal auditor can't just say that, oh, by the way, it's not my responsibility. I've just done a aggregation of A and B. So audit and review instructions are very important. So the B needs to be told that, hang on, you know what? There are these 5 things that have happened in the past in component A. Please check that this do not happen, or these happen in component B. Similarly, component A, Mr. Component A, while you're auditing, please make sure you do 1, 2, 3, 4, 5 things, which I believe as a parent auditor are a must for you to undertake as a component auditor, and please report me back on that. So what these instructions essentially do is the instructions lay out a overall framework for you to interact with the components. B, it provides adequate information for the components tomorrow to make their own judgment that whether the risk assessments done by them for that component cover at least those aspects which you want them to cover. Third is, it helps you interact for all important findings, because the instructions will not just be say, please do this. Instructions should also include how they should do it and in what manner and form they should inform you, and they should revert back to you with that information. So if you were to demonstrate, so let's say a regulator comes in knocking on your door and say, Mr. Principal Auditor, can you demonstrate that you've done enough work? What is that document that you will show them that you've done enough work. We'll start with scoping, and then we'll go to the review instructions. And Mr. Regulator, I have issued instructions to each of those components. These are detail of those instructions. It covered everything. It covered about the information of the group, my risk assessment, materiality, how the competent auditor needs to interact with me, how they need to make sure that they have done sufficient work. They tell me that they have done sufficient work. All of these are there. They also, what are the findings they have, and how I've concluded on those findings. Everything is, listed in those instructions. Here is the instruction that becomes your principal guiding document. Then, of course, is your conclusion. And as I said, a lot of times the conclusions go completely haywire because of the mindset to say either I'll just replicate whatever the component has responded to me, or I'll just miss it out. Say, I don't care. So in either situation, there is a challenge. What I'll do is I'll now sort of show you some of the evidences. So let's say, how should you be scoping it in? And generally, that's how you should generally document. Again, these are not templates issued by the institute, so please don't hold me onto that. These are just your way of documenting. So how you should do is component, just evaluate, put down all the balance sheet and income statement components into a simple, Excel file, plot all of these, which is a typically consolidation work paper, right? You will typically have a consolidation sheet prepared and presented to you by the company. You can use the most recent available, like for example, if you're doing March 23, pick up the December 22 last consolidation done by the company, or at times you could also have a draft consolidation available. You could also have MIS available, as just try and make sure that you have the latest information available with you. Do not use the March 22 or a March 21 data, because there could be significant movement from that while you do that. You may end up making wrong conclusions around that, right? So just plot this information both for balance sheet, income statement. Then you get to this scoping conversation, which I gave that example of ABCD, right? Put down the numerical. Then you put down the component materiality as to what you believe is the materiality that you would want. Then you put down the aspects of different work and so on and so forth, right? What you would want them to be doing, right? So this is again very important. This document, so if you see, it just puts down what procedures you would perform for each of these components. So let's say in our case of ABCD, audit of financial information, I will only do it directly, right? Because I'm the principal auditor. Audit one or more classes of transactions, because in our example, C was very material. I may choose to do audit one or more classes. I could do some specific audit procedures. E is not material. I may just completely scope it out or just do analytical procedures. B and D were also not material. I could just do a review of financial information, analytical procedures, and so on and so forth. So for each of those components, just document that what is the strategy that you're going to employ with respect to that component, right? This will help you navigate your component. I'll take you the next thing we discussed was instructions. Just again, a summary of instructions, just to give you an idea of how you need to go about documenting this. I think some problem with my Word file. Okay. Now, can you see my Word file? Okay, just 1 minute. Is it visible now?
Yes, sir. Now
Okay.
visible.
Okay. Okay. So as you can see, you can just put down the name of the group. Now, what is the contents? It should contain all the information. So if you see the information that is there, what is the work that you're going to be performing, and the timelines, deliverables, and other attachments, right? So here you should be detailed enough with respect to what is the information that you would want the group component to know. This will help you tomorrow to also make sure that the component has understood the group well, and therefore they are able to make a judgment that their risk assessment is appropriate with respect to that group. Just again, key information, what are the related parties, what are the significant risks, see, what are the important risks that you've observed in the past with respect to the group or the components, etc., right? What are the significant changes that have happened in the company over the period? Let's say there was a change in accounting policy that the company did. How would a component know? The component would not know. So these are the ways to communicate that to the component कि hang on, Mr. Component Auditor, ये accounting policy और practice जो है group ने change कर दी है. Please make sure that these are incorporated or the management has incorporated them and you have tested them specifically. Then what are the different work that you have to perform? You should perform, Mr. Component Auditor. What are the different things that you would want me to do? What are the timelines that you want? You should respond on. What are the important deliverables that are there? That's very important. That how you should evidence that the component auditor has understood your instructions and is acting upon those instructions is through these documents. One should be acknowledgement of group audit instructions कि भैया हाँ आपने पढ़ लिया है ग्रुप ऑडिट का इंस्ट्रक्शन आपको समझ में आ गया है आपको कोई प्रॉब्लम नहीं है आप दे दीजिए. इसके अंदर एक और इम्बेडेड होता है वो होता है इंडिपेंडेंस का. तो से कि आप मुझे कंफर्म कर रहे हो एज कंपोनेंट ऑडिटर दैट यू आर इंडिपेंडेंट विद रिस्पेक्ट टू योर ऑडिटिंग फ्रेमवर्क and therefore please make sure that along with the group audit instructions you tell them what is the auditing framework you are editing you're auditing on, and please ask from the component auditor कि भाई अगर आप कोई सर्विसेज परफॉर्म कर रहे हो कंपोनेंट को या पेरेंट को या किसी और कंपोनेंट को विद इन द ग्रुप आप हमें बता दो, उसकी असेसमेंट जजमेंट आप कर लो. ठीक है, अगर डिफरेंट जुरिसडिक्शन में है तो प्लीज आप करो तो बेटर है. देन अर्ली वार्निंग मेमोरेंडम्स व्हिच इज अगेन वेरी कॉमनली यूज्ड कि आप ऑडिट कर रहे हो, अगर कोई इशू आता है प्लीज हमें पहले बता दो सो दैट हम उसको ये डिटरमिन कर लें कि वो इशू जो है किसी और कंपोनेंट पे तो एप्लीकेबल नहीं है. तो इसलिए अर्ली वार्निंग, कंप्लीशन, summary of identified misstatements, these are all attachments that are very important for you to document in your files as parent auditor as a response from the component कि हाँ जी मैंने ये component को बताया क्या काम करना है, उसने मुझे बताया कि उसने क्या क्या काम किया और कैसे कैसे काम किया. ये सारी वो टेम्पलेट्स हैं आपकी. So your instruction should be detailed enough to include all information, risks, changes, how you would want the component auditor to respond back to you, what is that, those forms, formats, etc., and timelines, of course, around that. Let me open another sort of attachment, just 1 minute. How are we doing on time, sir?
So still we have 1 hour.
Yeah. No, I'll try and because it's important to explain some of these nuances for the
yes,
members.
Sir. Kindly.
The other template I would want you to sort of focus on. Is my screen visible?
Yes, sir.
Okay. So how do you address the responses? So let's say the person has given you information with respect to that there are some unrecorded or recorded misstatements, right? In that component. It's important that you get them to fill this template. Assimilate this kind of template कि भैया आपकी कोई भी फाइंडिंग हो ऐसे एक्सेल फाइल में आप डाल के दे दीजिए. इससे क्या होगा, आपका स्टैंडर्डाइजेशन मेंटेन रहेगा. दूसरा क्या होगा, आपकी एनालिसिस कोई मिस आउट नहीं होगा बिकॉज आपका सारी इंफॉर्मेशन अवेलेबल है. The chances for you to miss out any information or any finding will be rare. Third is that because you have the standardization available on that, you can cross-pollinate, which means that you can say that, okay, if component A has identified this misstatement, could be a component B also, could be a component C also. Then you can quickly just turn around. And more importantly, you can make your judgment. तो say कि भैया हाँ जी इसमें ये uncorrected misstatements थी, ये corrected misstatements थी. मैं एक और आपको चीज बताता हूँ. SA 260 is the standard which deals with communication of the principal or the let's say the auditor with those charged with governance, as we are aware. उसमें हमारी obligation है as a principal auditor to inform to those charged with governance not necessarily relating to only the parent company कि हमारी कोई ऑडिट फाइंडिंग हुई जी, ये ऑडिट एडजस्टमेंट हमने डलवाई, ये ऑडिट एडजस्टमेंट्स नहीं डली जो मटेरियली रेलेवेंट थी या नहीं रेलेवेंट थी, वो सिर्फ कंपनी ए के लिए बताने की जरूरत नहीं है, हमारी ऑब्लिगेशन नहीं है। हमारी ऑब्लिगेशन है कंपनी बी सी डी ई के बारे में भी बताने की। वो कैसे बताओगे आप जब तक आपके पास ये इन्फॉर्मेशन नहीं होगी? So you need to have that information available with you to say that, okay, we've issued instructions, we've got the responses from the competent auditors, and their responses essentially summarize ye 5 adjustments that were recorded by those management, and these are 10 adjustments which are not recorded by the management, which we believe either are material or non-material, therefore subsequent reporting around that. बट वो बताना क्योंकि जरूरी है, आपकी ऑब्लिगेशन है, आप उसको ऑब्लिगेशन को फुलफिल कर सकते हो थ्रू this kind of a documentation tool. And I would highly recommend that if you do not have a structured documentation available with you, please create some. Please structure documentation. These are very, very important. I'll go back to the presentation. Right. So I'll just go back. So these are, what the good documentation really looks like. I'll just reiterate some of the important challenges with respect to, as I said, and what I noted in the first or a couple of slides at the start of the session or deliberation on SA 600. How do you deal with a situation called overseas jurisdictions? And I said, if you have a component in US, let's say again, you're auditing company X has a component company A is in the US. Company A in the US is not required. There's no requirement in the law, unless it's listed in the US, that you have to have an audited financial statements, which means that there is no mandatory statutory requirement to sort of deal with or appoint an auditor. There could be that situation. Second situation where there are audits are mandatory, but the auditor essentially only has no experience of dealing with group audits. Absolutely no experience. He's never dealt in English. He's never dealt with large company group audits. He's always done small subsidiary audits, right? In that country. And third is there are different gaps. Somebody is following Czech gap, somebody is following Japanese gap, somebody is following US gap, somebody is following Brazilian gap. While the good part is most of the gaps are now aligned to either IFRS or US gap in some form and shape, but nevertheless, let's say there are different gaps available, which means that there are different, because at times there are local tax laws that influence gap judgments. For example, in one of the European jurisdiction, the tax depreciation is also the Companies Act, or let's say financial reporting depreciation, right? Which means that, like, for example, we today have a different useful life determination, the Schedule 2, but for tax purposes, a different useful life, right? And we do follow differently. Of course, if it's a financial reporting, we follow Schedule 2, we don't follow Companies Act, the income tax one. But in a lot of jurisdiction, both are supposed to be the same, right? Statutorily. Now, that could actually be a risk, right? It lead to a material misstatement. So different language issues, different regulation issues, how do you deal with that? First of all, 2-3 ways of dealing with it. Make sure that you apply your effort and energy only on significant components. Again, evaluated both quantitatively and qualitatively. When you deal with the significant components, if your significant component auditor, right, is never dealt with a large company audits or group audits, right? You cannot just rely on that report. You have to perform additional procedures around it. So your scoping template is very important. It'll tell you exactly, it should tell you exactly that, hang on, this component auditor is not experienced enough. Therefore, I may not be able to rely on the work done by the other person. And can I therefore just do nothing. Of course, I have to do something. So I'll then identify different classes of transactions where I believe there could be a risk or material misstatement. Then I go and access the books and records and perform some procedures. I cannot just blindly rely on that auditor, right? If there is a different gap, please understand for significant components wherever there are gap differences. Please push on the parent company management to ask the local component management to prepare a summary of gap differences between their accounting practices and the group accounting policies. They should mandatorily prepare that. And if they're not preparing it, in my view, it's a design gap in from a FSCP, financial statement control, financial statement close or consolidation process, as the case you may use it interchangeably, close process. Because in the absence of the document, how is the parent company management obtaining comfort that sufficient adjustments or appropriate adjustments that are supposed to be recorded while converting the local accounts to group accounts have been made? You don't know, right? Till the time you know where the differences are. So it's a part of an FSCP, a mandatory part of an FSCP, I would say. So please insist on that. You should have in your documentation summaries of each of the significant components, gap differences between local gap and the group accounting policies. Those gap differences, then you should map to the relevant financial statement line item and the relevant assertion, which then go back to the component auditor to say, hang on, these are the 2-3 differences that I've noted in, say, revenue recognition, in inventory valuation, in depreciation, employee ESOP accounting, tax accounting, this, whatever those differences are. Please, can you ensure compliance with the group accounting policies? Make sure that the transactions are accounted for group accounting purposes in this manner, right? So make sure that that template is available. How do you deal with a situation where, and again, a very common scenario, the local auditor will not issue an opinion to you other than in your sort of Ind AS gap. Let's say if it's an Ind AS situation, Ind AS, they will issue an opinion under. So either they will issue an opinion that according to them, the group accounting policies have been followed. So there is no material misstatement with respect to the group accounting policies. One, or there are a lot of times where the component auditor will just issue their audit opinion as applicable in their jurisdiction, right? So they'll say, here is my audit opinion, say under the auditing standard of that country or accounting framework of that country, please take that. I mean, that should be your red flag. Tuck, 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 tuck. Why? Because what it'll do is, while the competent auditor has given opinion with respect to the local gap, conversion of local gap into Ind AS is often done by the parent management. The question you have to ask yourself is, do I have sufficient knowledge to be able to opine on the accuracy and completeness of those gap adjustments or gap translations? The answer is no, because you're not auditing that component. Therefore, whenever you have material components where the component auditor, so first is push for the group accounting opinions. That the auditor, component auditor gives you an opinion separately to say that please perform the audit as per your instructions, as per auditing standard, blah, blah, blah. And in his opinion, there is no material misstatement with respect to the group accounting policy. He or she gives that, that's a good evidence for you on your file. If he or she gives you only local gap, you will have to perform some procedures using that gap conversion template, remember? Going back to and asking either questions of the local management or the group auditor to say, have you noticed this? Have you noticed this transaction? Have you noted that transaction? If yes, you have to then make sure that you test those transactions. Right now, the documentation we've observed is slightly lacking between on this step. And we very conveniently, the auditors write that some of these subsidiaries or JVs or associates are located outside India. The management has done the conversion, from local GAAP to Ind AS, and we have audited those adjustments. If you ask me, we have audited those adjustments means that I have ensured that I have tested for both accuracy, completeness of those adjustments, which in my view, unless I perform under underlying audit procedures, I cannot be saying that. To that extent, that's a gap, right? In our opinions. That's what I was saying, that you'll be surprised at the start that some of these gaps may exist in your current documentation. So make sure that for significant components, if you are to be auditing the gap adjustments, you do not just confine yourself to just agreeing those gap adjustments from the management work paper. You have to go back to the component, identify what are those significant classes of transactions. If there were gap adjustments, make sure that there is a paper in your file to say that you've done that diligence, and therefore then obtain comfort that yes, the management past conversion adjustments or entries are both accurate and complete. So I hope that would have given you some sort of insights. The other is again a very common issue you've noticed is there's often this confusion between how much of the proportion should be audited or audited, reviewed, unreviewed. And people often give a perspective, SEBI says that, by the way, 80% of the component should be audited or reviewed. Let's say if there is 100 rupees of revenue at the group level, as long as there is audit opinion stroke review conclusions of 80 up to 80, then that's fine. Well, that could be a SEBI requirement which is applicable for the company, but you as an auditor, you're bound by the auditing standards, right? The auditing standards, you have to make a judgment whether the proportion which is unreviewed stroke unaudited, is it material for you, right? So it could be a very large group, right? But your materiality could be sitting within the 20% which is unaudited or unreviewed. Can you, as a principal auditor, when you have the overall responsibility of the group audit opinion, say that while I'm fine with these 20% being unreviewed and unaudited because SEBI says that, so SEBI has not overridden that regulation under the LODR or whatever has not overridden your auditing standard or your obligation under the auditing standards. Your obligation under the auditing standards come from SA 220, SA 200, and SA 200 predominantly, then 220, and then so on and so forth, right? There you have to SA 320 and right whatnot. If that 20% which is not audited or not reviewed is material under the materiality determined from an SA 320 standpoint, you cannot conclude that you would not modify that report. So please be careful on unaudited stroke unreviewed components and what proportion of that would be to the financial information quantitatively, and if there are other qualitative aspects available, you cannot just leave them to say that, okay, I'm going to take the SEBI shelter. SEBI shelter is not available to you from the auditing standards perspective. Materiality, again, a common issue is that what should be the materiality. So I determine my materiality as X or Y. Now, I'll give you a classic sort of a situation. Company A, in our example, say, it was very profitable, but the company consolidated financial information. Let's say company A's standalone profit is 100 crores. Consolidated profit is 40 crores, right? Now, when you determine your materiality for auditing company A, you may come back and say, oh, I'm going to use 100 crores for the standalone audit opinion, right? But when you come to consolidation, you would have done all your work as per 100 crores, right? Materiality threshold, whatever you determine, 5%, 4%, 3% of that profit, whatever that you determine. All your sampling, all your scoping will be done accordingly. But can you use that evidence for the consolidated? The answer is no. Because from a consolidated perspective, your materiality is only 40 crores benchmark start, which means that you could be seen to be under auditing with respect to component A as far as consolidated financial information is concerned. Because if you were to do a consolidated, because it's a separate opinion, your consolidated financial statements opinion is not an aggregation; it's a separate opinion. It does not say basis the opinion I've issued on component A on parent company A, separate financial information, financial opinion issued on audit opinion issued on financial statements of A. In my opinion, the consolidated financial statements are. It's not like a tax audit situation, right? Where you refer to your standalone financial statements audit opinion. Here is a separate audit opinion. You write your opinion paragraph separately. So therefore, your materiality need to be very careful, especially in loss-making situations where parent company standalone is profitable, consolidated is a loss. As I said, there are a lot of communication coordination challenges. Those communication coordination challenges can be addressed only through a detailed audit instructions and follow-up through. Last is there are significant matters or findings of competent auditors. Please link them with other competent auditors. Second, evaluate them independently. Third, do not uh, isolate them. They could be pervasive. So you need to be very careful in how you sort of conclude. And as I said, last is the timing of reporting. That example I took, you're signing on the 1st of May, consolidated opinion, but the component comes back and provides you evidences till 25th of April. What happens between 25th April and 1st of May? So if make sure that your timing of reporting is as much close to your audit opinion as much possible, especially for the significant components. If not, because of whatever reasons, make sure that you have a follow-up discussion with both the local management and the component auditor to ensure that there are no subsequent events, that were relevant between 25th April and 1st of May, in our example, that you ought to have factored in, right? So make sure that, again, a very common sort of issue. Right. That sort of concludes the major chunk of our deliberation today, which is SS600. I can go on and on. These are very large standards, but I thought just sharing some important aspects, especially from a practice standpoint, would help you in doing your work. Okay, I'll just take a 1 minute water break. Please do write your questions, as much as possible. Very happy to learn from you, from your situations, from your experience. Eventually, it's a mutual learning. Coming to, again, a very interesting standard called SA610. I must admit that very rarely you would find this standard being applied in practice, for the simple reason that if you read the standard, there are so many ifs and buts. And I would say ifs and buts. This is amongst the 3 standards that we are talking about. At least I don't want to talk about the other standards, but amongst the 3 standards, this possibly is a more restrictive standard. It gives you a lot of restrictions that you should do this, you can't do this, you can't do that, or so because principally, please understand one very important aspect. Principally, even if you can use the work of an internal auditor under the standard, but it cannot and does not absolve you from your reporting obligation. The difference between SS600 and 610 is, while you can refer to the work done by the competent auditor in the other matter paragraph, you cannot do that for the internal auditor. You cannot say, oh, by the way, this procedure in my auditing work, or as far as my opinion is concerned, this procedure is performed by internal auditor, and so far as their work is concerned, I have relied upon, but they have performed it. You can't use that. You can't say that. Because you cannot say that, eventually you assume all responsibility. It's people are generally, we've seen situations where it's rarely used. Is it not used? Answer is no. Of course, it is applied, and and there are, and I'll give you practically where all it can be applied, the scenario. But it's a standard which is least common in terms of practice. Nevertheless, just to give you a perspective on what this really talks about. Whenever you're auditing, any financial statements, any company or whatever, you can, of course, you do come across a situation where the internal audit function is very strong. And often, doing your risk assessment or understanding about the company, you notice that, what, this company established a fantastic internal audit function. There are internal audit scope is very good, blah blah blah. Their coverage is excellent. The manner in which they assess the risks and perform their procedures is very good. Which, anyways, as part of the caro, I have to do that assessment. In doing that assessment, I believe that they've done a fantastic job as an internal audit function. Now, you may have two questions in your mind. You may say, can I use their work? Can I say, okay, anyways, they're doing the audit through the year, they're taking so many samples, there could be a pressure from the management side. अरे भाई इंटरनल ऑडिटर इतना काम कर रहा है, आप थोड़े से उसके सैंपल ले लो ना, मुझसे क्यों बोल रहे हो सैंपल यूज करने के लिए, अलग से निकालने के लिए, राइट? आप उसी का काम यूज कर लो, जो उसने सैंपल यूज निकाला है वही मैं आपको दे देता हूँ, आप वो उसको डॉक्यूमेंट कर लो, मतलब टेस्ट कर लो और डॉक्यूमेंट कर लो, राइट? तो यू में से यार हाँ, मतलब मेरा काम तो उसने कर ही दिया है, तो माइट एज वेल यूज दैट वर्क, राइट? So if so that could be one question going in your mind. The second question could be, you may come across and say, yeah, can I take their assistance? So one is that they're performing the work as per the scope laid out by the audit committee board, whatever that governance framework is, right? They have defined the scope. The internal auditors have done the work as per the scope. You believe the scope was fantastic, and you have in your head, yeah, might as well use my work a little bit, and get the internal auditor, whatever work he's done, let me take his sample, let me take his conclusion, let me take his whatever. So that is one part of question. Second could be that, yeah, might as well, unki assistance le lete hain, in doing some more work. And that could come up in, say, you're sitting in Delhi, the company plant, for example, in Kozhikode, and say, yeah, I'm under a lot of pressure. If I were to send somebody, I don't have an office in Kozhikode or anywhere near. So instead of sending my person all the way from Delhi to Kozhikode, I don't have staff, I don't have this. So might as well use their work. You use the people, internal audit team, which is sitting there. I just tell them क्या काम करना है, वो काम कर देंगे और मुझे दे देंगे. Right? These are two situations that could come up. The standard deals with both. ये दो situations है यहाँ पे standard deal करता है. पहला सिचुएशन है जहाँ पे इंटरनल ऑडिट का आप काम यूज कर रहे हो, दूसरा सिचुएशन है जहाँ पे आप उससे काम करा रहे हो, राइट? इज you are using internal auditor to do your work, and in the first situation you are using their work to conclude on your, right? They are two different things. And while the underlying restrictions almost are the same, but I'll give you the subtle differences which you have to be careful about, right? So we all know the relationship between internal audit and external audit. Just getting into a little bit of theory, which the standard talks about. Internal audit function or of the internal auditor. Now, by the way, internal audit function need not be only internal. Means that company ke paas apna, they can also use external firms. For example, like a external internal audit firm, which is very commonly used by companies. That's also, by the way, called as an internal audit function or internal auditor. It could be exercised either by the company, money in-house, by employing people, etc. A lot of these companies like GE, etc., globally have large internal audit functions, or it could be outsourced to completely to external firm, or it could be a combination of both internal function and outsourced to an external firm. But that all of that comprises of internal auditor. तो आप ये मत सोचना कि अरे वो तो वहाँ पे एक्स फर्म है, वो इंटरनल ऑडिट करती है, तो वो इंटरनल ऑडिटर फंक्शन नहीं है, वो तो मतलब एक अनदर प्रोफेशनल फर्म है व्हिच आई कैन देन कन्वीनियंटली यूज. नहीं नहीं, ऐसा नहीं है. सो डोंट फॉल इनटू दैट ट्रैप. एक्सटर्नल ऑडिटर, एज यू नो, हमारी तो जो स्कोप है वो सब कंपनीज एक्ट प्लस प्लस प्लस, देयर लॉट ऑफ प्लसेस बीइंग एडेड ऑफ लेट, लॉट ऑफ रेगुलेशंस एंड रेगुलेटर्स बीइंग एडेड टू आवर role and scope. Of course, the objectives are very different because the internal audit function, essentially, the objective is largely operational efficiency, effectiveness. It goes beyond financial reporting controls to entire operational controls. The scope is defined by the audit committee or the board, the appropriate governance level. In our case, the appropriate government cannot define the scope. The scope is, of course, defined by the law, and how we perform that is governed by the auditing standards. So they're completely different. As far as independence is concerned, please note, while we have to follow 144A, there is no 144A for internal auditor. So there could be, so as far as independence is concerned, again, a very common issue why people don't use this standard is that कौन जाके internal auditor से उसकी independence objectivity check करेंगे. It's a tedious task, but that's just to give you a little perspective on that. Now what the standard says is, before you go in using the internal audit function, you have to make sure that you understand whether the objective of the internal audit function is established. Give you an example. If there is an audit committee, and that audit committee essentially designs the scope of the internal auditor, and the internal auditor functionally directly reports to the audit committee chair, they ticks the box on objectivity. But in case of internal auditor does not report to the audit committee chair, and you have a significant management influence that it reports to the, let's say, the CEO or the CFO of the company or another executive director of the company, then can you say that the internal auditor is objective? The answer is no, right? Because that internal auditor is reporting to the management, not reporting to the governance function. The objectivity cannot be the same or assumed to be the same. Then you have to understand the technical competence of that person, whether he or she is a chartered accountant, not a chartered accountant, or even if it's a cost or a company, but understands the financial reporting, understands auditing standards, understands the framework within which the external auditors are supposed to work, and so on and so forth. So आपको उसका पूरा determination करना पड़ता है कि भाई कैसा है क्या नहीं है. Only when you are satisfied कि हाँ internal is objective, is competent, can you use them. The question that comes in is that in what areas can you use them? And I'll come to that. I'll answer that question when we will in the subsequent slides. But just to give you that perspective of the two different sets, या तो आप उसका काम यूज करोगे या आप उसको यूज करोगे एज डायरेक्ट असिस्टेंट, राइट. पहले की चीज में अगर आप उसका काम यूज कर रहे हो तो पहले आपको ये समझना पड़ेगा कि दोनों केस में ऑब्जेक्टिविटी वगैरह सब एस्टैब्लिश करनी पड़ेगी. बट जहाँ पे आप उसका काम यूज कर रहे हो तो उसमें आपको ये देखना पड़ेगा कि कोई भी कॉम्प्लेक्स एरिया में कभी भी काम यूज ना करो. उसका अलाउड ही नहीं स्टैंडर्ड में. दूसरा, इसके अंदर you have to ensure that there is adequate communication between you and him with respect to the work being used, right? There will be no written agreement, so you can't pass on that obligation to him. तो से भैया मैं तेरा काम यूज किया, कल को गलती मिली तो you are accountable. No, you will be accountable as parent auditor, not him. So him or her. So, but there is no written agreement. You can't have a written agreement to him to say that, oh, I'm using your work and therefore, the duty of care of that work falls onto you. That can't be the situation. As far as direct access is concerned, first of all, the arrangement is between you and him or her, right? Again, you cannot use for complex matters. But एक चीज और important है वो independence. You have to make sure that the person who's coming on as a direct assistant essentially is also independent as much as you are independent, right? Can't be a situation you're using a internal audit firm to say, for example, carry out a physical verification of inventories in some far-fetched location. You can use that, no problem. You can use that, but the point is, what if that or the partner of that firm holds many shares in your company? Can you use that work? No, the answer is no. You cannot use a share because that firm is not independent. So you have to make sure that the firm is independent. No, so that's again a very. But here you will have a written documentation agreement because person is working under your supervision, not the management supervision. These are two, as I said, different sort of approaches, right? I think what I'll do is, in the interest of time, come to the real, because I have to cover another standard. Simple question: what are the areas that I can use them? What are the areas I cannot use them? In my experience, the first section, which is where I can use the work performed by the internal auditor, can only be done for non-complex, routine, standard things. For example, could be physical verification of inventory, physical verification of assets, where there is no risk of material misstatement in those components, and the underlying work is not of a significance. So let's say typically you may say यार इन्वेंट्री के अंदर तो accuracy का risk हमेशा होता ही है, which is valuation gross, whether the inventories are computed or existence का risk होता है. But let's say there are 5 locations. The 4 locations comprise of 95% of the inventory which you have directly, plus the internal auditor has also done the physical verification, but you can use possibly that 5% wala. I'm just giving you numbers just to illustrate. These are not statute numbers, or they're not written anywhere, but just to give you a perspective that so non-complex area जो है ना, वो आप वहाँ पे यूज कर सकते हो. किसी भी कॉम्प्लेक्स एरिया में, जजमेंट, सिग्निफिकेंट जजमेंट एस्टिमेट एरिया में, जहाँ पे रिस्क ऑफ मटेरियल मिसस्टेटमेंट बहुत हाई हो, you cannot use the internal auditors, either their work or as your direct assistants, right? You cannot refer, as I said, you cannot refer to their work in your report, which means it's completely your accountability, whole and soul. So if that person ends up, renegating on the diligence required for that job, you are at loss, not that person. You cannot tomorrow come back and present that person in front of a regulator to say, please don't ask me, ask this person who's done this work, or he assisted me in that work. No. So it's your responsibility. So therefore, you have to be absolutely clear in what areas that you have to do and take their work. Independence, objectivity, I've given you an example that whenever you are using the work of an internal auditor, please tick the box on objectivity. Who defined the scope? Who is that person who's the internal auditor reporting to? Is the internal audit reporting to management? You cannot use, because the objectivity is compromised, even for the basic work. If you're using or internal audit is giving you direct assistance, in that case, you have to make sure that the person is independent completely, as much as you are independent, or you ought to be independent with respect to their audit line, right? Please make sure that you involve the audit committee and the board appropriately, especially when you deem to take either of the approaches, use the work or use internal audit for your auditing, for directing him to carry out some procedures. In either of the situation, make sure the audit committee and the board is aware, and it should not come as a surprise to them to say, "Oh, we didn't know that you had to take assistance from somebody else," right? Timing your involvement in documentation is very important. Whenever you ought to, do not take a judgment after the year end. Do not do that. Please make sure that if you intend to use the work of the internal auditor or use the internal audit to carry out your procedures, either of these situations, it ought to be planned well ahead of in time, which means that well before the financial closure, you got to be understanding, discussing, documenting the involvement. It cannot come as last minute. The common areas where often wherever limited we've seen is physical verification of inventories, assets, internal controls work, again non-complex areas, uh, uh, you know doing basic checks on let's say there is a company which has put in place a large project, or is doing a large project, and there is a concurrent audit which is right up there, which makes sure that every bill is pre-approved before it is paid off, right? So there is that, it is part of that control function. Then often we've seen in some situations, again, it cannot reduce your sample size, but you can use them as a complementary procedure and supplementary procedure, not complementary, I would say supplementary procedures, in addition to your already other defined auditing procedures determined in the 315. So that's the practical sort of challenges on this standard. Again, it's a very, when you go back to the article book, you may find a lot of pages, but trust me, most of those pages are very common. There is a very good implementation guide that the institute has issued on this standard, revised standard. Please go through that. It's a very question answer kind of a guide, which will help you clarify if there are any doubts on that. But the broad aspect of this, I've already explained to you. Mota mata, that's all you'll find in the guide as well. In the interest of time, moving to another very important standard called SA 620. This SA 620 is using the work of an auditor's expert, and I'll start with an example. So let's say you're auditing company A that has a lot of investments which are not consolidated or money, neither a subsidiary nor a joint venture nor an associate. Right? Because in those situations, as you know, under Ind AS, you can keep them at cost, those investments. And you have concluded that the management has concluded that those investments are going to be fair value through OCI, right? Equity investments, you make the choice that there will be fair value through OCI. Now, A, of course, has to prepare their financial information to determine the fair value. They appointed XYZ consultants, right, as valuers. Very common. You would have noted a lot of unlisted companies. Listed companies, you can take the quoted price. Often, not always, but often. But in case of unlisted companies, you cannot take, there is no price available. So you have to work out different methods to arrive at a fair value under the standards, which is the principles of which are laid under Ind AS 113, for example. You can refer to that standard. I'm not going to go into that detail. But the question for you as auditors is that how you deal with this situation, right? When you're auditing these fair values, how would you deal with that, right? The management has appointed XYZ consultants, right? A lot of times people come back and say कि भैया valuation तो एक expert ने ही करा है और मैंने उसकी report ले ली है as audit evidence or I'm fine with that, right? The question is, can you call this as sufficient and appropriate audit procedure? Please note, XYZ is not an auditor expert, he's a management expert. Management has appointed XYZ Limited, and therefore the natural duty of care and obligation is towards the management. You cannot rely on that work blindly. It cannot act as an audit evidence. That is, XYZ consultant's report can be it cannot be an absolute audit evidence. It is not an absolute audit evidence. It is not a third-party audit evidence. Oh, third party has given a report on this. First of all, he's not a third party, right? He's very much part of the management. Management has used XYZ to carry out its own work. Management is supposed to have determined the fair value, but they've used XYZ to determine that fair value. So it's very much part of the management. It's a management expert, right? So therefore, you cannot and should not deal with this blindly. So say, भैया उसकी report आ गई, मैंने अपनी file में डाल दी, and that's it. Good. Second is materiality consideration. You may come back and say, suppose the company has hundreds of investments. 100 reports should I take? Of course, you can use materiality here, consideration for auditing. The question then is that we as auditors may not have the right skills. And I'm using the word may because a lot of us do, do have or may have. So please don't take it otherwise. So may not have the skill to audit a valuation report, right? What is the right method? Whether the right method has been used by the valuer, whether the assumptions used by the valuer with respect to different variables are those appropriate or not appropriate? Quite frankly, we don't necessarily have the underlying. We may not necessarily have the underlying information required for that purpose, right? Because that comes from multiple sources, and those sources are not necessarily easily accessible, especially because it's an unlisted valuation, company valuation, investment valuation. So the question then comes is, I use an expert, right, who comes in as an auditor expert, cannot be XYZ consultants. So I, as an audit firm, it is required under the auditing standards that whether I look at 540 or look at other standards, whenever I'm auditing an area which is neither accounting nor auditing, domain, let's say in this case valuation, I should be, and the underlying amounts of material, then I should be using an auditor expert who's other than XYZ consultants in this example, who looks at the work of XYZ consultants and says, hang on, is the method used by XYZ consultants appropriate within the valuation norms, especially in valuation standards? There are valuation standards available, plus requirements of 113. Second, have the appropriate consideration given to information data available? Third, whether the work done by XYZ consultants is appropriate and reasonable. And that auditor expert does not report to the management; it reports to you, and he doesn't have to give a separate report which is in public domain to say this is a fairness. It's not a fairness opinion on XYZ consultant's report. It's a work that you want that expert for your purposes to be done, which means that auditor expert on a standalone basis has no locus standi in the audit. On individual basis, no locus standi. He's got a standi only with respect to your work. He's assisting you in auditing the work of XYZ consultants, right? Which means that you therefore own up the work done by your auditor expert. Again, you cannot refer to that work being done. It will be termed as a limitation of scope in sense. It's a modification. Can't be to say, oh, by the way, as far as valuation is concerned, in the other matter paragraph, I say I have referred to, I appointed Mr. Mr. PQR as consultants who looked at the XYZ's work and found it to be appropriate. You cannot say that, right? It's not. Your obligation is very much there. You are the person as auditor whose neck is going to be on the line in case any work is found to be of not appropriate standards. Which leads me to the last consideration, which is documenting the results. It is absolutely important that you very clearly document how you've appointed the auditor expert, what is the scope of that auditor expert, what is it that he's looked at, underlying documents of how he's gone about testing and checking each of the variables of the valuation report, how he or she has formed their opinion on that work, and how you have reviewed that he is done. The PQR, in our example, PQR consultants has done adequate work to be able for you to conclude that yes, XYZ's report is okay or not okay, right? So I thought I'll just explain you with respect to that example for you to understand this concept of an auditor expert here. A lot of times we as auditors often miss this trick, because we often say that the person who's given the report to the management is independent, is objective, all that. Please do not do that. The standard does not permit you to do that, right? Here, in terms of theory, you have to determine the nature, time, and extent of the procedures that the auditor expert has to perform, right? It is you who determine where all you need to have the auditor expert, not the management. You determine that. You have to appoint an auditor expert who's completely independent with respect to the management and even the consultant that is assisting the management. A lot of times, you could come back and say, oh, by the way, for convenience, PQR and XYZ are actually network firms. Can PQR be, your auditor expert? The answer is no, because he's part of the same network as XYZ, and XYZ has been your management consultant. So PQR is not qualified to be your auditor expert consultant. So expert. So be careful on your point. I've already talked about that. As I said, you cannot make a reference of that auditor's experts work in your audit report. You cannot do that. Please, that will be termed as a qualification. These are some of the examples the standard also talks about. And commonly, impairment assessment is a very common example. Suppose a company has a lot of intangible assets, a lot of goodwill because of business combination. They appoint management consultants to determine, to carry out that impairment assessment under Ind AS 36, then you have to appoint auditor expert, again, depending on materiality and so on and so forth, to do that. When a business combination happens, how to determine the fair value of the different components involved in the business combination. Again, you use management. So, or valuation of fixed assets, valuation of plant and machinery, wherever there is some complex judgment estimate required, where there is a management, either appointing a management consultant or by itself, there is complexity involved with respect to determine value, etc. I think that's where the auditor expert should be used. Very again common is actual calculation of liabilities. Now, uh, I've there are very few cases where auditor experts in practice are used in this, but in case actuarial liabilities are material on your balance sheet for whatever reasons they are, then it is highly advised that you do not just blindly take the actual report of the management expert. The actuary report that people often just document saying that trace to the actual report is actually a management consultant. You have to, if the amounts are very material, there are significant changes, whatever quantitative, qualitative aspects, then you got to be having another actuary who acts as your audit expert, looks at that actuary's work and then concludes and give you a conclusion. So IT service companies where there are large number of employees, employee obligations are very material. Often this situation is used. Estimation of oil gas reserves, environmental liabilities, law firms, where you want to understand if there is a particular litigation or a case going on, uh, uh, either a tax or a non-tax. What is the probability? You do a PPR assessment, under 37. Management often uses a law firm to do an assessment. If the amounts are underlying material, then you've got to be using uh, a law firm as an auditor expert to validate and test the other law firm's conclusion on that, right? So these are different examples where the auditor expert is often used and should be used, I would say. As I said, the following challenges and issues that we've come across very commonly. Um, Materiality, often materiality is not appropriately used and defined in carrying out this work. We've seen situations where even for material items, the auditor expert is not used, but for common items which do not be material, of auditor expert is used. So you have to be very careful that only for items that are material or there is a likelihood of material statement for that particular assertion that you should use an auditor expert. Not otherwise you'll end up wasting time, energy, and effort on, on auditing. You have to be very clearly understand the role of the expert. A lot of the time, the underlying expert gives you a heavily caveated report, which you just file, right? Classic case. Let's take our example only, where he was doing the valuation, right? Testing. The management did a valuation using, say, a DCF method, and that DCF method said that these are the projections available or given by the investee company, and there is a how this is done. The auditor expert will come back and write you a caveat that he is not tested the reasonableness of these projections. He's only tested whether the valuation methodology approach, etc., is reasonable, and it gives you that report, and you file that. If I'm a regulator, I'll say, hang on. So who's done this work on auditing the projections? You can't say, by the way, because the expert has not done that work. So you got to be doing that work. So you have to understand what is the scope, what is it that the expert is going to do. Only so in your assertion, it is important to audit that estimate also, right, of that projections. Expert is not going to do that, so you have to do that. So it has to be a combination of both. So therefore, be careful on defining the scope, understanding what are the caveats, that what is it that the expert is writing or saying to you that he is not done. You have to make sure that either you do it or it's not relevant to get those things done of further assertion, right? Like for example, tax, highly loss making, you're not required, so not required, right? So you have to determine that. Documentation, as I said, it can't just be one report that you just file from even the auditor expert or a memo. You have to document how that expert has gone about completing his or her work, and each of that will form part of your documentation and comprehensively, because the regulators would like to see what you've done as an auditor to see to provide oversight and supervision to the work done by the expert. Independence, competence, I've talked about this, that you have to make sure that the auditor expert need to be as much independent as you are with respect to the audit client. There is due consideration which is given to that specialization and competence of that. So it can't be that I just appointed any other registered valuer who's never dealt with valuing. So suppose you are doing a valuation of a large plant, large asset that you bought. The company appointed some valuers, but you've appointed an audit expert who's never done in the history such large valuation by themselves, right? So they would not necessarily know the nuances and variability. Or for that matter, you made an acquisition in Japan, right? And you're appointing a Indian valuer or as auditor expert to test whether the fair value in Japan. How would he know that what are the considerations relevant for the Japanese market to do a fair, work on the valuation audited side? So that's all. I thought I'll have again. I've tried to squeeze these standards within the given time frame. These are all large standards, particularly 600 and 620, which are very commonly applied. I'll be very happy to answer any questions that you have. Again, in the interest of time, just leaving about 8 minutes for those questions. Apologies if I just overran the session a little bit, but I thought it was important to cover some of the elements which I did.
Thank
Thank
you
you very
so
much.
much. Thank you so much, sir. You have covered almost all the aspects of all the three standards. Sir, I have received certain questions from the members. First question is, what if the statutory auditor does not agree with the written opinion of the company? 15 years old tax consultant and other independent renowned law firm among top 15 in India. Can the auditor force his decision without relying on the work of the other experts? The auditor is adamant to satisfy his ego.
Okay, so there are multiple questions involved. One is a technical question, the other one is non-technical. So
Yes.
I will not answer the non-technical in terms of the ego and all that stuff. That's
Yes.
non-technical.
Yes.
But in terms of the
Yes.
technical question here, there are two aspects. First of all, that the basis of conclusion of the auditor needs to be well thought through, right? So if the auditor believes that his or her position is appropriate, that will be basis something, right? Typically, if an area is complex, for example, tax or law, it is advisable that the auditor also appoints an auditor expert in this matter. Could be a tax consultant, a law firm, or a tax lawyer, whosoever, or or any other auditor expert to form a view. And if that view is in contradiction to the view undertaken by, there would be basis for that, right? It is best that the auditor arranges a conversation between the four parties, which is management expert, himself, and the auditor expert. To in that conversation, if there is still a deadlock with respect to the fact that there is still difference of opinion, I think the auditor is very much entitled within the auditing standards to express that difference of opinion through his audit report, his or her audit report, with suitable modifications. Uh, so that, I think, framework is very well defined within the auditing standards, 7001, 705, whatever the standard you want to refer to, in terms of where there is a difference of opinion. But it is important that uh, whatever you conclude, please conclude basis a well thought out position using an auditor expert, and making sure that there is an adequate opportunity given to the client to explain their position And once there is a genuine difference of opinion, then express that difference of opinion through the audit report.
Ji, sir. So whether NOC from the previous auditor is compulsory before acceptance of the audit?
Yeah, absolutely. That anyways is defined within the code of ethics and as a mandatory procedure. And I'll tell you why it's also important, because you as an incoming auditor may not be aware of all information that you ought to be aware, because when you're doing a client acceptance, there is only so much that you are aware of through external information or your interaction with the media, with the management, which is again very limited, right? When you're coming in, incoming as an auditor. So it is important that you ask your professional colleague who's been auditing that company for many years or whatever, to understand if there is anything that he would like to tell you, or you would like to know from him or her, that it will help you in eventually carrying out your procedures. In case there are serious issues with respect to the integrity of the management, etc., etc., often that helps the auditor, new incoming auditor, to even take a decision whether to accept this client or not. I would two things. It's a very good question. There are two things. One is, unlike in India, we have this restriction of looking at the work paper of the previous auditor or having a formal communication with the previous auditor. In overseas jurisdiction, it is mandatory for the incoming auditor to have a discussion conversation, and I think it is a very important point that maybe through implementation guide or through some modification in auditing standards under SA 200 or maybe 220 or whatever, that it is cast upon the incoming auditor to have a formal meeting with the previous auditor on certain aspects and define those aspects like integrity of the management, operational areas, difficult areas to audit, any complexities that the auditors, previous auditors have faced. I think it is important and only healthy to have that conversation between the two audit firms, retiring and incoming. That will only sort of enhance the overall, audit quality eventually.
Yes. So one member is asking to put some light in the process of making the group audit instruction by the principal auditor to the component auditor.
Sorry, can you repeat the because voice to me was
Share, a member is asking to share the process of making the group audit instruction by the principal auditor to the component auditor.
okay. So there are, I think, maybe there are two parts to the question. One is how should you go about preparing that instruction. Second is, at what point in time do you send those instructions and how do you follow up? There are two aspects of this question. First is in terms of making sure that you prepare. I make sure that whatever you prepare, that in that instructions should very clearly lay out three things: information about your understanding and information about the group. Second is what are the past issues, etc., etc. Third is whatever the you would want him or her to do as component auditor at the bare minimum. So once you have that simple in a Word file, you can just list them down. These are the 5 things or 10 things that you would want to do, how you would want to communicate. Uh, as I said, there are no standard templates available, uh, but I think the chairman auditing standard is making an effort to compile and make available for the members some of these standard templates. And I think in due course you will have those templates. The second aspect is timing of it, and again that's a very good question. That what point in time should I send the instructions? Ideally, the instructions should be sent well before the year end or the reporting, let's say, if it's a reporting review, quarterly reporting, well before the quarter ends. Reason being that you have to provide sufficient time to the competent auditor to have understood the instructions and act upon it. Please make sure that you just do not only send those instructions. If it's a significant component, as you categorize them, this is what I discussed, then you please have a conversation through other means like a telephone conversation, a Teams in conversation, or Zoom conversation, and make sure that you satisfy yourself that the other person on the which is the competent auditor has understood your instructions, and there is a channel communication established through that.
Yes, sir. Sir, another question is If a company has its foreign branch, the foreign branch is audited in their country. What precautions to be taken while consolidating such foreign branch with head office in India?
Absolutely. Excellent. Again, I believe it's a, so if it's a foreign branch and there is a statutory requirement for that to be audited under the local requirements, please understand what are those local requirements. Second, please make sure that the auditor is qualified. When I say qualified, not just the professional qualification, but independence, objectivity, etc., to be able to carry out the audit. I gave that example during my deliberation. You could have a situation where in some jurisdiction there are liberal independence rules, but you are relying on the work under your auditing framework. So you have to make sure that there is parity on that side. So make sure that you can rely on the work. Third is make sure that you send them instructions to satisfy yourself that they are covering at least areas for material misstatement relevant for that branch. Again, depending on the materiality of the branch, it could be 1 area, 2 area, 3 area, 5 areas, whatever those areas are. Make sure that those instructions do go out. Fourth is typically if it's a foreign, you would have a gap difference uh, uh, because of local regulations and your country gap, money the gap in which you are opining on. Make sure that the management prepares a summary. Management prepares a summary on the differences between the local gap in which the branch accounts are maintained and the consolidated books, money your group accounting policies. If those gap adjustments are or differences are identified, make sure that the local auditor of that branch audits those gap differences specifically and provides you information on that through an opinion. Last but not the least, if he or she gives you an opinion which is under local regulations, right? Uh, I would strongly suggest that depending on the materiality, you carry on some supplementary procedures to satisfy yourself as to those gap adjustments, and also to make sure that there are no differences between your gap, which your auditing standard in which you are reporting, and the underlying auditing standard on which he has reported to you. So these are the 5 6 steps that you should do and you should be doing.
Yes. So for scope assessment, in your opinion, should we take total revenue at group level or external revenue at group level?
So when you say total revenue, and I think you're making a differentiation with respect to the intercompany. I think you should take the net revenue, which should come into consolidated finance statements, which is both net of intercompany transactions and even net of any transaction variable consideration adjustments required under 115. So let's say your gross revenue, and there could be two situations, right? Suppose your gross revenue is uh, 10 crores, but there are certain variable consideration adjustments, and you end up reporting revenue consolidated at 7 crores. So you should take 7 crores, not 10 crores. One. Second is suppose there are intercompany transactions and which are included in 10 crores, but after intercompany they come to 5 crores. In that case, you should take 5 crores. So what you should report, what you're reporting eventually as part of your financial statement line item as revenue to the public money the company is reporting to the public uh, shareholders, the public stroke shareholder, then that's the benchmark that you should take always, not the gross revenue.
So can component audit ignore the timeline given by the group auditor of the issuance of the audit report?
No, it cannot. But please understand the component auditor has two roles. One role, often those roles converge, but there could be a situation where those roles do not converge. One is the statutory requirement to be an auditor. There'll be local regulations. Let's say within Companies Act, he's also acting as a statutory auditor. And then he's also acting as a component auditor because that company is a component of the parent company, right? Often, as I said, the two roles converge, which means that the timelines are set like that. That the board meeting of the component happens, the board of that component adopts the financial statements, and then they get consolidated. But there are situations also where the board meetings may not happen, for whatever reasons, prior to the board and this typically happens in case of overseas jurisdictions. Not so much. I've not seen so much in India, but very likelihood that these happen in overseas. So then
Yes.
what you end up having is a statutory audit report dated after your consolidated report. And that is the situation I was telling, that you have to be absolutely careful in those situations. If it's a material component, you have to draft your instructions and your communication slightly differently in this situation, because you can't afford a scenario where, for example, there is no gap difference, there is nothing. Uh, the competent auditor issues you a report on X numbers, but the statutory financials are signed with Y numbers. Make sure that that does not happen. That is likely to happen in these situations.
Yes. Yes. So last question. Sir, can the internal auditor be expected to conduct the review engagements of interim financial statements with the same set of competence as the independent auditor? Continue. If not, can you please help us in point out towards any published literature that can be shared with the audit committee and management to drive home this point?
So you're saying internal auditors doing the review of the financial statements, is it?
Ji.
Hmm. I think internal auditors cannot substitute your work with respect to a review of the financial statement. As mentioned in the 610 revised, this will typically come in directly. You cannot use, in my opinion, you cannot use the internal auditor to say that, okay, if the internal auditor has reviewed the financial statements, then I don't need to do that because he's already reviewed it. Or I use the internal auditor and direct him, please review the financial statements. In either situations, it will be a non-compliance of the overall auditing framework, because that's very much part and parcel of your work. You're opining on this financial statement, not the internal auditor. And this definitely comes into area of restriction uh, in that. So therefore, I would, my opinion, please do not use internal auditor work or internal auditor himself as direct assistance for review of financial statements. For certain components of financial statements, as I said, which are non-complex, which are sort of not material enough, where the risk of material misstatement is not there, there you can use for the components of financial information, but not the financial information taken as a whole.
Thank you so much, sir. Now we come to an end for today's webinar. It was wonderful deliberation. You have covered all the aspects of all the three standards, and it is very difficult to speak at a stretch for more than 2 hours. And hats off to you, sir. And once again, thank you so much for sparing your valuable time and acceding to our request on a very shorter notice, as well as in the time where you're almost all the you're jam packed with due to the audit committees, and you have given your consent for this webinar. So once again, thank you so much for your kind deliberation, sir. Thank you so
No,
much,
thank
sir.
you for giving this opportunity. Thank you so much.
Thank
Appreciate
you,
it.
sir. Thank you, sir.
Thank you.
Namaste.
Bye bye.